All right, let's get right into it. The market is basically stuck at a crossroads right now. On one side, you've got this escalating US-China trade drama creating a ton of headline risk. And on the other, you have a major technical support level that the bulls are fighting tooth and nail to hold. So the big question is, which one is going to give out first? Okay, so here's how we're going to tackle this. First, we'll look at the geopolitical chessboard. Then, the mixed signals we're seeing in volatility. We'll dive into specific sectors, lay out 3 possible scenarios for the market, and finally, some risk-defined ways you might think about structuring a trade. First up, the geopolitical chessboard. Look, right now, the entire market story is being written by the US-China trade conflict. This isn't just some background noise, you know? It's the main reason we're seeing all this crazy intraday volatility and those risky overnight gaps. So let's look at the calendar, because these are the dates that every trader has circled. And these aren't just hypotheticals. We're talking about hard deadlines. That October 15th talk about rare earth controls, that was a serious warning shot. Now, everyone is laser-focused on that November 1st tariff deadline. But then you throw in the APEC conference and all these rumors of a truce, and, well, you can see why the market has no idea which way to go. And the language being used is just getting more and more intense. You see quotes like this, and the hardline view is pretty clear. China's not playing by the rules anymore. They're weaponizing their supply chains. And when you hear talk about needing to punch back, well, that tells you the odds of more back-and-forth retaliation are getting pretty high. But see, this is the market's big problem right now. In the same breath, you hear officials saying, look, we're taking action, even if the market tanks. But then they immediately follow it up by leaving the door open for another truce. It's this exact kind of mixed messaging that's causing all the chop, and why nobody can seem to get a firm grip on direction. All right, so let's move on to volatility's conflicting signals. We've talked about the geopolitical mess, now let's see what it's actually doing to the charts. And what you find is this massive tug of war, with a really solid case to be made for both the bulls and the bears. I mean, look at this divide. It's night and day. The bull case is pretty much a contrarian bet. They're saying, hey, everyone is terrified, the VIX is spiking, and Q4 is usually strong, so buy the dip. But the bear case is all about what's happening right now. The S&P is technically weak, it's under its 20-day moving average, and you just can't ignore that constant headline risk. And that brings us to what might be the single most important number on the S&P 500 chart right now, 65.47. This isn't just some random level. It's where you find both last week's low and the 50-day EMA. It's holding for now, but make no mistake, this is the line in the sand. If we break below this, it's a huge victory for the bears. And if you look over at the VIX, the market's fear gauge, it just backs up this idea of risk. It's just sitting there, holding stubbornly above that key 20 level. And what's really interesting is the amount of options volume piling up at the 25 strike. What that tells you is that traders are actively betting on, or at least hedging against, another big spike in volatility. The whole thing feels like a coiled spring. Okay, let's zoom in a bit. Section 3, sectors under the microscope. Because if you look beneath the surface of the major indexes, you'll see this conflict is hitting different industries in very different ways. The semiconductor sector is basically ground zero for this whole battle. I mean, on one hand, you have the super bullish AI story, but on the other, you have the direct threat of the trade war. The next big test for the whole sector is going to be TSM's earnings, and we're already seeing a split. NVIDIA looks weak, it's already broken that 180 support level. Meanwhile, AMD is showing some relative strength. But the risks are massive, and they're real. Warnings about lower China sales, the rare earth threats, any of that could throw a wrench in the entire supply chain. All right, moving beyond the semis, there are a few other names with really clear setups. You've got Tesla just completely pinned between 425 support and that huge wall of options resistance at 450. Gold is looking strong, really bullish momentum, and the options market seems to be betting on a move toward 400. The small caps, IWM, look a bit stretched here, maybe due for a breather. And then you have something like Bungie, which is just doing its own thing, showing strength based on its own agricultural trade news. Educational content only. Compiled from public sources, may contain errors or delays, no financial advice. Markets involve risk, including loss of principal. Options are risky and can result in rapid losses. Do your own research and verify all data. Okay, so with all that in mind, let's put it all together into 3 possible scenarios. Think of this as a game plan. It helps you figure out what to do based on what the market actually does next. So here's how it breaks down. Our base case, which is basically where we are now, is just more chop between that 65.47 support and 6,700 resistance, with every little headline jerking us around.
The bull case gets triggered if we can decisively get and stay above 6,700. That would probably need some good news, like a real tariff truce. And the bear case? Well, that one's simple. We break that 65.47 support. That could be triggered by China retaliating, or if we get confirmation that those November 1st tariffs are actually happening.
All right, last section. Let's look at a couple of ways a trader might use options to build a trade around one of these ideas. And just to be super clear, these are purely for educational purposes, built on the analysis we just went through. So, first up is the debit spread. It's a really common way to make a bet on direction, either up or down. You're basically buying one option and selling another one at the same time. The whole point is to lower your cost and, most importantly, lock in your maximum possible loss right from the start. That's absolutely crucial when the market is this choppy. So, how would this work with AMD? Well, the idea here is that AMD is looking stronger than its peers. So instead of just buying a call and hoping for the best, you could use a call debit spread. That way, if you're wrong, maybe the whole market rolls over or AMD just hits a wall at resistance, you already know exactly how much you can lose. Your risk is defined.
Okay, next up, the iron butterfly. This is a totally different kind of trade. It's a neutral strategy. You're not betting on the stock going up or down. You're betting that it's going to do nothing. You want it to stay stuck in a really tight range so you can profit from time decay and a drop in volatility. And this setup fits that Tesla situation we talked about perfectly. The thesis is that Tesla is just going to stay pinned between that 425 support and the huge 450 resistance level. So an iron butterfly centered right around 450 is a direct way to play that idea. And your uh-oh moment is crystal clear. If it breaks out hard above 450 or breaks down below 425, the trade is invalidated and you hit your max loss. Not trading advice. Markets are volatile and unpredictable. No guarantees. Trade your plan, manage downside, and verify all information. And that brings us right back to where we started. You have this clear, technical line in the sand holding up against this massive wall of geopolitical risk. So the question you really have to ask yourself is this dip a buying opportunity, or is it the last warning sign before the floor gives out?